To maximize a small farm for tax write-off, it is essential to understand the tax laws and regulations that apply to agricultural activities. The first step is to establish a legitimate farm business, which can include planting crops, raising livestock, or both. This business must be operated with the intention of making a profit, as the Internal Revenue Service requires a profit motive to qualify for tax deductions. Next, keep accurate and detailed records of all farm-related expenses, including equipment purchases, seed and supply costs, labor expenses, and property maintenance. These records will be necessary to support tax deductions and credits. It is also crucial to separate personal and business expenses, as only business expenses are eligible for tax write-offs. Another key concept is the distinction between hobby farms and commercial farms. If the farm is deemed a hobby, expenses can only be deducted up to the amount of income earned from the farm. However, if the farm is considered a commercial operation, expenses can be deducted regardless of income, and losses can be used to offset other sources of income. To further maximize tax benefits, consider depreciation of assets, such as equipment and buildings, over their useful life. Additionally, explore available tax credits, like the Conservation Reserve Program, which provides incentives for farmers who set aside land for conservation purposes. It is also important to consult with a tax professional or accountant who has experience with agricultural businesses. They can help navigate the complex tax laws and ensure compliance with all regulations. By following these steps and maintaining accurate records, small farm owners can maximize their tax write-offs and reduce their tax liability. This can help improve the financial sustainability of the farm and support its long-term success.